There's a lot of talk about a coming economic recession lately, and investors are justifiably asking questions. For example, are we in a recession already? What happens to the stock market during a recession? Should we invest differently if we get into a recession? These are all legitimate questions. The good news is, by the time you finish watching this video, you'll have your answers to these questions and a lot more. Let's start with the basics. First, what is a recession? Well, the textbook answer is a recession is a significant decline in economic activity that's spread across the economy and that lasts more than just a few months. The start and end points of recessions are announced by the National Bureau of Economic Research, NBER, and that's an independent nonprofit organization. This definition is a little vague and it's open to interpretation. So most economists like to be more specific. They identify a recession as 2 consecutive quarters of negative growth in the GDP, gross domestic product, which itself measures economic activity in the United States. So in other words, economic activity, if it shrinks for 2 consecutive quarters, many experts would call that a recession. It's not so cut and dry though. Remember that the definition of a recession requires a significant decline in economic activity. So if there are 2 consecutive declines, but those declines are mild, the economists might not call that a recession. The bottom line is there's a lot of discussion and disagreement as to when a recession starts and what it really is. This is really important to remember because since there is no hard and fast rule to determine whether we're in a recession or not, it boils down to the economist's opinion. Having said all that, most economists agree that we aren't currently in a recession because economic activity hasn't declined, at least not yet. As you can see in this chart, the gray line, which indicates changes in GDP, is going down, which means GDP growth is slowing, but it's still positive. The blue line indicates that leading indicators are negative, so the future direction looks troubling. In other words, we aren't in a recession yet, but the direction of the GDP raises concerns. When will the next recession happen and how bad will it be? Well, while most economists agree, as I said, that we aren't currently in a recession, many fear that the economy may be headed towards a recession over the next 12 months. Now, that isn't as bad as it may sound. According to Kiplinger's, the U.S. economy experiences a recession every 3¼ years on average, and since World War II, the average recession lasted about 10 months. For long-term investors, that really isn't a problem. And keep in mind that it takes 2 quarters or 6 months to know if we're in one or not. That means it's possible to have been through the worst of a recession before it's even officially declared. This is also important, very important to remember, and something we're going to come back to. Before I go on, I just want to suggest that you subscribe to our channel and hit the notification bell before I forget to ask. This way you'll be notified when we release future videos that are vital to your retirement success. Back to our subject at hand. Not all recessions are alike. Some last a long time and others are short-lived. Sometimes the stock market suffers steep declines during recessions and other times it doesn't. According to Fool.com, the S&P 500 drops about 18.5% during the average recession, and it takes a little less than 2 years to recover. Again, this is the average, and it's no guarantee of what may happen in the future. You can see from this chart, however, it's usually better to hold on to your long-term investment strategy than to overreact. In the past, long-term investors have been richly rewarded for holding on during rough periods, even though, again, this isn't a guarantee of the future. And given that we can't predict recessions in the future, and that we may be through the worst part of a recession before we even know we're in one, your approach should be judicious. While you should consult your own advisor before making an investment decision, don't sell investments and go to cash during recessions. That's because you could be selling at the very bottom of the market when fear is greatest. You should always be on the lookout to make sure that your current holdings are appropriate to achieve your long-term goals. But once you have a solid investment approach, don't change it just because you think there might be a recession or once the recession is officially announced. If you have or obtain cash, use dollar cost averaging to wade into the market. This basically means you put a little money into the market each month, so you take advantage of lower prices, but you don't pile all your money into the market at once, just in case the market declines even more. We'll release a video specifically on how this works and who this works best for. Make sure to subscribe and smash that notification bell so you'll know when we release that video. I want to give you a very few specific nuggets to help you invest during recessions. Keep in mind that during recessions, the Fed typically lowers interest rates. That may or may not happen this time around, but if it does, that can be bad if you keep rolling over one-year CDs at lower and lower rates. It can be very good if you have fixed income instruments such as bonds, as they generally appreciate as rates go down. In fact, one strategy for investing in a recession is to buy bonds or preferred shares as they can appreciate when rates are reduced. We've covered both those investments in prior videos, so make sure to subscribe to be notified when we update those specific investment ideas. Also, if rates do decline, utility stocks, as well as companies that issue mortgages, could do quite well as they tend to thrive during interest rate declines. We did a specific video on how Larry uses Seeking Alpha to find unique and attractive investment ideas, so make sure to watch that video if that's of interest. I want to talk about debt. The Retirement Crusaders always recommend getting rid of your debt, and this is even more true during recessions. That's because recessions often force employers to cut jobs, and if your job gets cut, you may find it difficult to make your debt payments. This, of course, is more of a problem for people who are working and less a concern for retired people. But if you are retired, you're likely on a fixed income, so debt is still something you want to avoid. If you can get rid of your debt, especially credit card debt, do it. If you have an adjustable rate mortgage, now might be the time to consider locking in a fixed loan. This way, if rates go up, you won't be forced to make higher payments each month. Now, you might find it difficult to pay down debt and or refinance your mortgage, but at the very least, do whatever it takes to refrain from taking on more debt during a recession. If that means cutting back on monthly spending, downsizing, or even taking on a side gig or taking in a renter, consider any and all of these ideas. The last thing you want is to be backed into a corner when you have to make higher and higher debt payments and if your income is in jeopardy. And along these lines, refrain from co-signing other people's debt. This is something we've always been against and say it all the time, but it's even more important during economic uncertainty. Let's talk about savings. Having an adequate emergency fund is super important during a recession. If your income is diminished because of the economic contraction, you'll need that nest egg to tide you over. So if you can continue to build up your cash reserves, even if we're in a recession, do it. I want to give you the most important takeaway when it comes to recessions. As I said earlier, recessions usually last about 10 months and happen every 3¼ years. That's the average. Some recessions last longer and some are much shorter. But the main thing to remember is they don't last forever. The economy and the market recovered after depressions, war, presidential assassinations, and even after 9/11. As you can see from this chart, while the past doesn't guarantee the future, the market has always recovered from even the worst of economic and historical events. Again, it's no guarantee of the future, and sometimes it took longer than other times to recover. But in the big picture, the only thing investors really should worry about when it comes to recessions is making an emotional sell decision they later come to regret. When the recession hits, the market could take a steep tumble. And that's scary, I know. But if you don't sell, you won't lock in the losses. The only way to really hurt yourself financially is to freak out and sell at huge losses because of your fear. When people do that, they lock in the loss and they give up the opportunity for the future, in the future, to recover. And stay alert. During recessions, you'll hear all kinds of hucksters on the radio, TV, internet, and the internet. They're trying to get you to invest in some recession-proof idea like gold or silver. Yet these precious metals have been a terrible investment over the long run. We'll do a video on gold investing soon, so make sure to subscribe so you'll be notified when we do. Now, if it's not precious metals, it will be something else that's speculative, but that they guarantee is recession-proof. They ramp up their advertising during recessions because this is when fear is at a high pitch. And when people are afraid, they make emotional decisions rather than smart financial decisions. The shysters know this, and they try to take advantage of it. So beware. Speak with your own advisor before making any investment decisions. As always, keep a long-term perspective and stay educated. That's the best way to make sure you'll make smart financial decisions for your retirement security. For more ideas on how to secure your retirement, please subscribe to our channel and smash the notification bell. Also, be sure to look in the description below to this video. You'll see a link to join our Facebook group where you can interact with others about retirement issues, and also we have 10 free booklets on important retirement issues.